Hello and welcome to the MilVet Podcast. Your podcast hosts are Brendan Aronson and Tim Shaw. We are military veterans, entrepreneurs, and investors. Most importantly, we strive to empower military service members, veterans, and their families. We believe that every veteran deserves a career that fires them up, a career in which you can learn, earn, and build a world-class network. On this podcast, we interview civilian and military veteran leaders who are incredible founders, writers, thinkers, and investors. Our primary goal is to inspire you to achieve great things. Let's dive into today's episode.
Hi, this is Tim. I'm joined today with Sebastian Mallaby, Sukin Yang, and Will Rich. Sebastian Mallaby is one of the foremost financial reporters, writers, thinkers, and I consider him an incredible public intellectual when it comes to the intersection of finance and its application and effect on modern society. Most recently, he's written the book The Power Law, which everyone on our team at Context Ventures has a copy of and has read. It's a fantastic book about the history of venture capital. As one would assume with a firm name like Context Ventures, we really believe that studying the history of an industry, of a business, of a vertical, helps you understand what's happening in the present, which then helps you understand what will happen in the future. There's a little bit of a George Orwell reference to that. But today, we want to talk to Sebastian, not just about the power law, but about his own career, because a lot of military veterans have to make several different transitions in their careers. And Sebastian's writing career and his span of topics has been fascinating and varied. So we'd love to learn today about his writing and professional journey, and then also talk about what he's working on today. So without further ado, Sebastian, would love to learn what led you to the power law, and what message would you like for that to have within the venture capital community and the world overall?
Well, thanks, Tim. It's great to be with you. I got to writing the power law because I'd already done three other kinds of financial history. One about central banking in the form of a book about Alan Greenspan, the former Fed chairman. One about hedge funds. One about sort of development finance. That was a book about the World Bank. And so, a natural progression was to find another slice of modern financial history which I hadn't done yet and which hadn't been done by others. And by far the most exciting one, it seems to me, was venture capital, and kind of the whole question of what made Silicon Valley so special. Why did it dominate this particular kind of finance for a long time before it began to spread out just in the last 15 years or so. And so I made a first few trips out to Silicon Valley and had a few conversations. And at first, I must admit, I thought of not doing the book because, I got a lot of slightly superficial, cute stories about how venture capital deals got done. But then after a bit, I felt I was getting underneath the surface. I was understanding how you allocate capital in a field where there are no quantitative metrics for whether you should invest. And that kind of got my juices flowing. I wanted to explain to people by telling the story of the history, how do people allocate capital when you can't talk about the price earnings ratio, you can't discount the value of the future cash flows. All you can do is evaluate individual entrepreneurs who come into your office with a dream. It's a different kind of underwriting, a different kind of finance, and I really wanted to get my head around that.
I've listened to several of your podcasts, and one of them that you've done most recently was fascinating when you compared and contrasted hedge funds and venture capital. And the one thing I find it really interesting was hedge funds you almost described as loners, as people who kind of like go do deep research, figure out some type of way to generate alpha, whether it's arbitrage or algorithms, whereas VCs are heavily on the networking side. And then you even shared how you think, there's different types of individuals for different industries. But then what you felt was, how should I say, more necessary. Like if one VC was gone, another VC might do the deal. But you mentioned how hedge funds, they kind of create unique ideas, and then like it's unique to them. And I'm curious, do you still feel that way, or have I butchered that kind of explanation?
No, you've done a very good job of summarizing it. I mean, an example maybe brings it home. You know, there was this one character called Lewis Bacon, a famous macro trader, who I went to see, and you know, he was this sort of figure behind four different screens, and he almost sort of didn't poke his head out from behind all those screens, and I had to kind of look around them and say, "Hey, Lewis, I'm here," um, and you know that kind of insularity of the trader, the sort of, you know, deep in the data, thinking hard about why something might be mispriced. All of the data that you need in hedge funds are basically, you know, available on a screen. So it's a deeply analytical thing, and you can be solitary. And in fact, when Lewis Bacon did well, made a lot of money, bought himself a private island, the joke was it made no difference because he was already so insular. Whereas with venture capital, you really got to be out there. You've got to be, you know, you're not investing in something on a screen. You're investing in an individual's idea for a startup. And you have to meet that person, bond with that person. Imagine if you could actually go on the board of that startup and get along with this founder, you know, for 7 or 8 years or whatever it takes to build some value in that company. It is a very kind of interpersonal, EQ intensive kind of work.
The uh, the application of that with military veterans is pretty important because so much of what we do in terms of post-military is networking to find a job. And VCs really need to be networking. And I tell founders that, and even teammates, that you have to go meet people. Like the best deals don't come to you. You need to go hunt for them. Um, and it's just, it's really interesting around that difference that you kind of crystallize between the two industries. I'm curious, when I heard that analysis, I thought maybe one of your books in the future will be around private equity leverage buyouts, given that feels like it's another bucket of privates. Is that of interest to you or not really?
Yeah, I have thought about that from time to time. I think it is interesting that you know, the private equity industry got going around 1980 or so with the leverage buyouts of the 80s. And before then, everybody pretty much who thought about finance from an academic perspective would have said, well, public stock markets are very efficient. It allows endowments and pension funds to own slices of corporate America for no fees, right? You just go on the stock market, you might pay a small brokerage fee to buy the stock, but once you've bought it, you can buy it, hold it, and there's zero fee to pay. But now, if you imagine a world in which the same set of companies have been bought by private equity managers, you have to go to the private equity company and pay them 2% a year of the assets and 20% of the upside on any profits they make in order to participate in owning that piece of corporate America. So it's a highly expensive shift from the point of view of the allocators of capital. And it implies that, you know, unless the allocators are dumb, they think they're getting some value for that shift, right? They are paying this big fee to the intermediary because the intermediary is going to make the assets perform better. I think it's a fair question whether they really do perform that much better. And whether or not they do, it's just something you wouldn't have predicted in 1980, that so much of American capitalism has shifted into the private ownership format and away from public markets.
I think what you just said is so important. And yes, it's generally covered all the time in Wall Street Journal, but that is how much of the markets these days are private markets. And one of the first things that another veteran did when I went to business school, we had a veterans club, and he's like, let me tell you all how finance works. And he said, at the very beginning, you have venture capital. That's the finance involved, and then hopefully all through all these series A, B, C, D, E, Fs, and maybe G and beyond. But eventually, hopefully, it's a public company, or it gets acquired, or it shuts down, and then you become a public company, and then it grows big, and then it starts to lose its focus, and then sometime around the public company stage is when hedge funds start trading it. And then suddenly the company doesn't do so well, mismanagement, and then private equity comes in and tries to restructure it and then redo it. And so that was a pretty helpful kind of framing of like the finance industry when I was first coming in. And I think as it pertains to that, it's fascinating that so much of that market is now private. Um, all the startup space, Uber, as you wrote about, was able to stay private for very long, and you talked about it through the Yahoo chapter around how SoftBank did a giant round. In fact, I'll stop talking about that and just would love to hear you talk about how venture became a very cottage industry to one that's become so important to finance.
Yeah, I mean, you're alluding to a very important shift where it's not just that the private equity business, in the sense of really big companies, has grown hugely since it began around 1980, but separate to that, within the technology realm, there is this trend towards companies just not going public for a long time because they can carry on raising yet another private round of money. It used to be, when Amazon was a big success story in the late 90s, it raised one round of capital. It achieved a valuation of around about $500 million, and then it went public, and it's been a public company ever since. But today, you've got all these companies running around called unicorns, meaning they're worth more than $1 billion. In other words, twice what Amazon was worth when it went public, and yet they haven't gone public. They've remained private, and they can be worth 10 billion, 20 billion, 50 billion, even 100 billion, and still be private technology companies. And I'm a bit troubled by that in the sense that I think that, there's a slight distinction between these unicorns and the private equity owned companies. In private equity, typically the private equity partnership buys 100% of the ownership of the company that used to be a public market company. So it controls the whole thing, and then it has to manage it. It's got, every incentive to wade in and be activist and make the most of that company and make it return profits. But in the technology space, where you've got a company that began with venture capital and then just never went to the public markets, they grow and they grow and they grow. And each time they raise some more money, the ownership becomes diluted, and shared among more and more different shareholders. The capital structure, the cap table, becomes more and more complicated with ever more different types of investor crowding in. You've got Series A, B, C, D. By the time you're up to, G or something, you've got whatever it is, 8 or 9 different kind of tranches of investor. And they often have special complicated rights associated with each round, which makes it difficult to understand who really controls what. And none of them has a clear incentive to say, I'm the owner, I'm going to step in and really pay attention to what's going on with this company. And when you dilute the ownership like that, nobody is really minding the store. And so the entrepreneurs can get away with mismanaging the assets. And that's kind of what happened with WeWork and with Uber, 2 famous stories where a successful tech company at one point goes off the rails. And I just don't think it's good for technology if, every time there's a Netflix movie, it's about one of these unicorns that's gotten too big and nobody was minding the store, and then bad behavior creeps in, and then it's embarrassing.
I thought what you were going to say is that you were worried that so much of the value is captured by the private market, not the public market. And I totally agree with you that there's an issue with all the Theranos, WeWork, Ubers in terms of mismanagement. But it also feels that the private market's getting bigger simply because the private firms are accruing all the value.
Yeah, and so then the question is, why don't these private firms choose to go and have a public market listing? They would have done in the 1990s or any time before that, and they simply stopped. And one story is regulation. That regulation became too onerous on going public, and so companies wanted to avoid it. But I think also that there are potentially other reasons which are a bit troubling. You could say that too much regulation is a bit troubling. But in addition to that, I think, some managers don't want to have oversight from shareholders. And if you're on the public markets, you have to do a quarterly earnings call, you have to communicate with public shareholders. If you screw up, your stock price is going to fall, and that's a very visible sign that you're not doing well as a manager. And so to avoid all that transparency and scrutiny, which I think is healthy for managers, managers may choose to just keep on raising another private round of what's called growth equity, and avoid the headache of being scrutinized by shareholders.
There's a balance there, of course, because sometimes startups need to have a quarter or two, or maybe even three, where they're quote unquote pivoting. And obviously, in the public markets, a pivot is seen as a giant sell off.
Well, yes and no. I mean, in theory, public market shareholders own the stock because they believe that there will be profits in the future, and that'll make it worth owning the stock. And if you pivot and you say to shareholders, you communicate clearly and say, we are doing this and it's going to be painful, we're going to make no profits in the next 2 quarters, but once we've got through this restructuring, it's going to be great and we're going to earn more profits. Then if it's a persuasive story, shareholders will not be dumb, they will understand it, and they ought to be buying the stock, not selling it. Now, I know lots of people who manage public companies, and they tell me, no, that's naive. Shareholders just dump the stock anyway, no matter how good your story is. So maybe the theory is not quite the reality, but it's a nuanced thing. And there are cases where, public companies have gotten away with not making profits for a long time because they promised to make profits in the future. I mean, Amazon didn't make profits for years and years and years, and people still bid up the price of the stock. By the way, the whole definition of a bubble in the public equity market is that shareholders are too long-termist, right? They are looking too far into the future and willing to take a promise of profits way off in the future when they think about the price of the stock today. And we know that there are bubbles in equity markets, and therefore it just isn't true to say that stock market investors are always short-termist. If they were always short-termist, there would never be a bubble. So I think that public markets maybe actually work better than many people think, and that the discipline of your stock price going up and down in a visible way could be a healthy signal, keeps you on your toes. So I'm a bit more sympathetic to public markets than maybe is fashionable. And I know for sure that it's a cheaper way to do intermediation, right? If you're, raising the capital because you're a company, you can go raise capital from lots and lots of different shareholders because it's a public equity thing, which, any retail investor can access through a brokerage account. And if you are providing the capital, you're not paying 2 and 20 to a private equity intermediary, and that's saving you a ton of intermediation costs. So it ought to be more efficient.
I want to double click on this a bit more because in the power law, you also examine the dual class structure of Google and how in many ways they started this trend of a dual class structure. And you talk about before this, it was a bunch of media companies. So New York Times has it and some others. But this whole public private the balance of power I find fascinating. I find it actually to like kind of bleed through your conversations and podcasts and the power law. And so I think my question is the dual class structure plus the ability to raise so much capital in the private markets seems to even more be taking away power from retail investors and the public markets overall. Would you agree or disagree?
Yeah, I agree with that. I mean, in fact, in the case of these tech companies, it's actually also taking power away from the private investors, right? Because they may buy stock. Okay, so maybe with Google, obviously that's public, so that's a public market thing. But I think what I'm trying to say is there's been this broad shift towards saying, look, the entrepreneurs who start these companies, these are the real heroes. They're creating the value. They're the geniuses, and therefore we should give them plenty of power. And the finance guys who just come with money, they should deserve less power. And that's a story which, one understands why it's appealing to people. But I think that even a genius founder who is a brilliant engineer who starts Google or something, most people do better if there are checks and balances, just like the US Constitution. And it's good to have oversight. And when you give the founders these super voting shares, where they have 10 votes for each share that they own, compared to 1 vote per share for the rest of the owners, it just gives them too much power, and they can ignore the investors. And the investors do serve a purpose in having an opinion about when the company is being mismanaged. If you ask the question, would it be normal to suspect that the founders of a startup can take a company public and remain the CEOs right through, the next 25 years, when the company totally changes shape, changes the geography it operates in, changes the markets it's operating in? Would it be the natural for the same person to be running the company? No, I don't think it would be. And therefore, I think, outside investors who can maybe trigger a shift in who the chief executive is, that is a healthy thing, because as companies change and morph, they need different people to run them.
I want to peel the onion even more on this, and that is through reading the power law and just observing our own dynamics with founders and just politics and everything commercial. Increasingly, there's this power, not just between privates and publics, but between individuals and institutions. If anything, the power law is charting the rise of the individual over the institution. And I feel like this is playing out not just in venture capital, but also in politics, in book writing. And to, maybe this is, I'm going to sound ridiculous, but it feels like there's a power law in terms of individuals and their ability to affect kind of the economy and politics and overall. And I know that was a bit of a ramble, but I'm curious, does any of that make sense?
Yeah, I think that one commonly discussed phenomenon when economists talk about globalization and technological change is what's called the superstar effect, where, because you can be a fantastic surgeon or a fantastic lawyer or a fantastic whatever, and you can reach a big audience because, first of all, there's technology, so you can broadcast your expertise. Secondly, there's globalization, so people from all over the world could potentially come and get your services. That leads to a situation where the most skilled people can charge an enormous premium for their expertise. And so you have this power law distribution where, 20% or even maybe 5% of the best performers in any given segment are making 80% or 90% of the money. So I agree that this is a broad phenomenon that cuts across institutions and individuals, and it's not just about venture capital.
What's interesting about the power law is it was published right before kind of the rise of VCs and their influence actually in politics. So most recently, Trump selected J.D. Vance, who spent a little bit of time in venture, but he's also relied a lot on venture capitalists for fundraising. Peter Thiel being one, but Andreessen Horowitz has said they would back them. Based off your readings of venture capital history and where we are, do you think VCs will be even more, how should I say, prominent or aggressive in terms of their ability to influence things beyond purely venture capital?
Yeah, I think it's a function of the rise of technology and its importance in national life. Obviously in economics and in the generation of growth, right? Although venture capitalists only back a fraction of 1% of all the companies that get started every year, if you look at the big companies in the United States, a crazy high proportion of them began in that way, with venture capitalists at their root. So venture capital is a very influential, albeit small, industry. Another way of thinking about this is that between 2000 or the 1990s up to the 2008 financial crisis, hedge funds, which I wrote that other book about, were sort of the sexy frontier of finance. And I would say that, after the great financial crisis, you had a period when finance was more heavily regulated and banks actually didn't do terribly well on the stock market, and hedge funds made less good profits. And the really exciting frontier of finance was the financing of technology, in other words, venture capital. And so from that, shift of power from Wall Street on the East Coast to Silicon Valley on the West Coast, goes with it a kind of political ripple effect where, it kind of makes sense that today you have a vice presidential pick who used to be a VC. It's just like fits with, just in the same way that we had this run of Treasury secretaries and top economic advisors in the White House who all came from Goldman Sachs during the 1990s. So too, we're now going to see more people who come out of technology and are influential politically.
One of the things that you've consistently said is you think hedge funds still play an important role, and you're bullish about that. I'm curious, do you still feel that way about hedge funds, and do you also feel that way about venture?
Okay, I'm definitely bullish about venture. I think that model of basically conducting applied science experiments through multiple startups is just the most effective way to get innovation started. Trying to innovate within a big company is always difficult because whatever you do is going to be disruptive, and that includes disrupting the company that you're working for. Whereas if you're in a startup, it's just a freer environment and a more focused team with which to go after a new technology application. So I think that's why venture capital is spreading outside Silicon Valley. It moved into China in the period around 2005. It's moved into Europe. It's in India. It's in Southeast Asia. It's a little bit in Latin America. It's really going global, as well as spreading around the United States. So I really am very bullish on venture capital, and the more that software eats the world, as Andreessen said, the more kinds of product get disrupted by software, the more that venture capital is going to matter. And it's this includes defense, obviously. I mean, we've had Palantir, SpaceX, now Anduril, and a bunch of other defense tech companies coming up behind them, in a way that I think we just didn't have that from the kind of creation of the famous defense primes, Boeing and Lockheed and all those guys way back when. There was a long period when they kind of just remained dominant, and there were not these sort of venture-backed challenges, and now there have been. So I think venture is really spreading and becoming more and more influential. On on hedge funds, I think it's a bit more nuanced. I mean, I basically still remain bullish because I think that the incentive structure within hedge funds to really do deep research on inefficiencies in public markets remain unparalleled, right? If you are managing a hedge fund, you've got to do the work to really get it right, because you've got your own money in the fund. And if you screw up, you're losing your own fortune. And at the same time, if you get it right, because you get 20% of the upside, you're really, rewarded very, very powerfully. So the hedge fund people are the people who really do work to understand where there may be mispricings in public markets, which I think is healthy for the functioning of those public markets. So I'm kind of in favor of them, and I think that they do have better incentives than, big banks and other too big to fail taxpayer-backed entities. Hedge funds are not taxpayer-backed. When they fail, they just fail. And that small enough to fail quality kind of keeps their feet to the fire and makes them work hard. Now, having said that, they've had less good returns over the last 15 years than they did before, which I think is mainly about quantitative easing, having driven down risk spreads and driven down volatility. When things are less volatile, it makes it tougher to make money as a hedge fund manager. Maybe with now higher interest rates and higher spreads and so forth, that will change. So perhaps hedge funds will come back into their prime. But I don't think they're going away, put it that way.
A few things for the military veteran audience. First is not many people know that there's been a number of titans of finance that have a military veteran background. So one of the co-founders of Carlyle, Danny Daniello, was a veteran. Stephen Schwartzman actually served too. Charlie Munger was a veteran. Bill Foley, Vinny Viola, Virtue. So there's a number of veterans who have made a mark in finance, even in venture capital. Kleiner Perkins, the third partner, Frank Caulfield, he was a vet. And there's a number of fantastic venture capital firms started by veterans, Altos Ventures, Meritech, and many more. One of the things that you also said, Sebastian, that's interesting is defense tech. And I've done a poll of both military veteran VCs and also civilian VCs that invest in defense tech and dual use. And the rule of thumb has generally been that about a quarter to a third of defense tech startups are actually founded by veterans. And that kind of makes sense because it's one of the few industries where veterans actually have a leg up, just given what they've done in the past, and they can speak that parlance. We generally think that it is a very heated sector, but obviously there's still opportunities. One of the things that I really appreciate when reading your books is how I spend my day in venture, but I feel like you actually have developed perhaps a deeper understanding of the industry purely through the study of it. And I'm curious, how much time does that take? Like, it really feels like you get in the weeds of every single book you write, and would love to learn more about your process of that.
Sure. Well, I mean, I start from the perspective that, there's a lot of books out there, and if you're going to write another one, you better write a good one. Otherwise, you're just kind of cluttering up the world. So I do take a lot of time, and, typically it takes about 5 years for me to do a book. That's because I really want to get to speak to people across the industry, people who are senior, experienced, knowledgeable, who really understand it. And those people tend to be busy. So, I have to make a case to them that it's worth spending, 2 hours, 4 hours, sometimes 6 hours with me. I'm not in it to just go have coffee and leave after 20 minutes. I wouldn't learn anything. You'd be saying, you'd be introducing yourself still. So I want to go there with my recording device. It used to be a digital recorder. Now it's just my iPhone. And I want to put that device, turn it on, put it on the table and say, okay, we're recording this. And I really, really want to deeply understand how it is that you approach your work. And if you do that and you persuade people that it's worth their time to talk to you because you're going to take it seriously and contribute a book which is sort of valuable to people's understanding of what they do, I think you do get a sort of special outsider perspective. If you're working in the industry, you're kind of doing deals, you pick things up, but you're not formally studying it in the way that I do through these oral history interviews. And then I layer on top of that, a reading of the academic literature, which is a bit sparse on venture capital, I would say, but there's some. I read memoirs by people who've been in it. I read, there are a few sets of oral histories, sort of long interviews with people who've been in Silicon Valley, which you can find on various online libraries maintained by the Computer History Museum in Mountain View and other organizations like that. And so, if you take 4 or 5 years and you really study this stuff, I think you can come up with some sort of categorizations of different styles within venture and a sense of how venture contributes to making Silicon Valley work.
What I really appreciate about the power law is A, your understanding, but B, your storytelling. Because the history is people tend to think it makes you fall asleep, but as we know, history is people, and people are always fascinating. And I feel like you do a really great job of talking about the people and how they impacted the industry. Can you share your journey as a writer? And so, how'd you start? The different books you've written. I've got a couple copies here: The Power Law, The Man Who Knew, The World's Banker. But I think even before these books, you were already a writer. And so, can you share that?
Yeah, I mean, I got out of college. I studied history at Oxford, and I went pretty much straight to The
What type of
Economist
history?
Um, uh, I was studying late 19th and early 20th century European history, and I was obsessed with the question, why was there no Marxism in Britain? Which is a slightly, maybe, you know, less of a preoccupation today, but when you thought about, that period when there were revolutions all over the place, from 1870 to sort of, I don't know, the
Even
First World War,
1848, I
thereabouts.
want to say.
Yeah, even 1848, that was a sort of a liberal set of revolutions. But yeah, um, there were revolutions in Russia, obviously, in France multiple times. In Germany at the end of the First World War, there was, strong left-wing movement in Spain during the Civil War. And Britain was really the outlier. Nothing like that happened. And I came to the view that it was because the system in Britain, the government system, was flexible enough to sort of absorb critics better. Every time people got angry with the inequality or the lack of the sharing of the vote with all people, something would happen, a reform would happen that would, sort of incorporate and accept some of the critique. And so through that gradualist adjustment, it wasn't like Russia where you went from a czarist autocracy, pretty much straight with a sort of 6-month interlude, straight to, a communist dictatorship, because there was that, flexibility in the British system. Anyway, I was very interested in that. But
Real quick before
aside,
you move on,
yeah,
sorry. I find that people who study communists generally are people who really love history. And it makes sense because Marx was someone who had, hey, this is the dialectic and this is the history of economies and businesses. And for what it's worth, in high school, I nerded out on Russian communist history. So Bukharin, Tolstoy, or not Tolstoy,
Trotsky.
Trotsky,
Yeah.
Stalin, anyhow, sorry to interrupt.
Yeah, no, I agree. I mean, I was interested in Marxian history. I mean, I was not, a Marxist, but I was a Marxian, or at least I was interested in sort of thinking about that line of thought. Ironically, my books are all kind of anti-Marxian in the sense that Marxian history is all about, the impersonal forces that drive history, whether that's technological change or changes in the structure of industry. And those things clearly matter, but I've become more focused on the way that individuals make a difference, and whether that's Greenspan leading the Federal Reserve, or whether that's individuals who are at hedge funds or at venture capital outfits. I'm quite focused on people, but I think it's good to have understood the impersonal forces at college as a basis for then going on to write about the personal forces as a professional writer. But I think through the history study at Oxford, I became kind of quick and fluent in writing history. I took that into journalism at The Economist magazine, and that trained me in sort of analytical, explanatory writing. And then when I was about, I guess, 25 or so, I was standing outside Nelson Mandela's jail as The Economist's Southern Africa correspondent. And Mandela was released, and I realized that all the other books on Southern Africa were now totally out of date, and that the release of Nelson Mandela was probably the most exciting thing I would ever witness personally. My career was going to be downhill thereafter, and so I should make the most of that moment and write a book about the future of South Africa. So I called it After Apartheid. and I wrote that book about South Africa. So I got into both journalism and book writing, pretty early on in my 20s. I loved it, and I kind of, as it happens, it turns out there's one thing I can do, and that is to write these history stories. And since I enjoy it and it's worked out for me, I've stuck with it.
So after the book about the apartheid, is it The World's Banker that was your next book?
That's right. Yeah, yeah. So there was a bit of an interlude. After writing the book about South Africa after apartheid, I worked for a while on the finance desk of The Economist, which sort of deepened my understanding of finance and economics. I then went to Japan and spent some time as The Economist correspondent in Tokyo. Learned some Japanese, learned more about banking and finance, covered the breakup of the political consensus in the 1990s in Japan. And then I came to Washington, D.C. and covered politics and national affairs, wrote the Lexington column in The Economist magazine. From that, I joined the Washington Post and was an op-ed columnist and an editorial writer on the editorial board of the Washington Post, writing about economics. And then that was when I wrote the next book, which was the one about the World Bank under the leadership of Jim Wolfensohn, who was a sort of, fiery character who annoyed people deeply, but also inspired them quite deeply, and ran the World Bank between 1995 and 2005. And I did this kind of real-time portrait of him as he did that job. He was a crazy character, so that was pretty fun.
And then after that, you worked on a book about Greenspan, or was More Money Than God the next one?
Yeah, the next one was More Money Than God, about hedge funds, which was kind of a way, as I've said, of, understanding public markets, really the deepest students of both the bond market and the equity market and the currency market and anything publicly tradable. Are these hedge fund leaders, because they are incentivized the most to study it deeply. And so a lot of the cutting edge theories about how, markets might be inefficient come out of hedge funds. And so the history of hedge funds is in a way the history of public markets, from the 1960s or thereabouts until the 2008 crisis. And then, one of the things that these hedge fund people do is that they often find themselves trading against central banks. So central banks will be trying to defend the value of a national currency. Let's say in 1992, the UK government was trying to defend the value of the British pound. And then along come a bunch of hedge funds and bet against the value of the pound, and the weight of the hedge fund trading causes the currency peg to collapse. And then the hedge fund make a ton of money. So I wrote about that from the hedge fund side, but then I flipped the table and wrote about it from the central banker side in the form of this biography of Alan Greenspan. And the idea was partly inspired by the 2008 financial crisis. It seemed to me that you had this system which was of finance which was quite stable, but very regulated in the 1950s and 1960s. And it had evolved through the 70s, 80s, and 90s into something that was freewheeling, not very regulated, and kind of crazy, which had then totally blown up in 2008. And so the question was, why would the regulators, the public financial statesmen, have allowed this system to go off the rails? And I understood that Greenspan, who had kind of come into the public square as an advisor to Richard Nixon's campaign in 1967, 1968. His career from 67 through to the 2008 financial crisis, where he had been, advising presidents in the White House with Jerry Ford as the president of the Council of Economic Advisors in the 1970s, then back in public office, appointed by Ronald Reagan to lead the Fed, and then at the helm of the Fed through, the George H.W. Bush years, the Clinton years, and then the George W. Bush years. he really had been central to public finance for 40 years. And if I got into the cockpit of the airplane with Greenspan as a pilot and I flew across that landscape, I would be able to understand from the inside, like, why did you make those decisions which caused the situation to be so unstable, which then blew up in 2008. So my biography of Greenspan is kind of the making of modern finance told through this one statesman's life.
And then after that is obviously the power law. But now you're working on a new book. And when we last spoke in person, you had shared a little bit about it, and that it was going to be a book about a primer on artificial intelligence. Can you share more?
Yeah, so having written a book about the financing of technology, in other words, venture capital, I'm now writing a book about the technology. And the technology, of course, I'm focused on is artificial intelligence, partly because, it's such a massive topic of discussion right now, and it's really broken out in terms of the large language models like ChatGPT, which have caught everybody's imagination. But more than that, I think, AI raises sort of fascinating, deep questions about what it is to be human, and also about human motivation. Why do scientists build technologies which could turn out to be dangerous? It's kind of the Oppenheimer question that people ask about the making of the atomic bomb. And we are kind of re-asking that now about the people who are creating artificial intelligence. And it turns out that when you get close to the creators of AI, they themselves are deeply familiar with the stories of Oppenheimer and the atom bomb. And they are the most articulate kind of exponents of the parallels. And so I'm spending a lot of time with Demis Hassabis, who is the founder and chief executive of DeepMind, the Google AI lab. And he is a wonderful, thoughtful and fascinating leader in this space. And I want to write, the story of his creation of DeepMind and of what DeepMind has accomplished since 2010 when it was formed, in terms of building systems that can do things like unraveling the shapes of proteins in human nature, which will unlock, medical advances, and building, one of the large language models, the Gemini model, which is, one of the most capable chatbots out there. So that's what I'm up to right now.
How much will the book cover the hardware aspect of it? Because Venture's roots are hardware, Fairchild Aid, the Trader's Aid, but AI, at least in the public markets these days, AMD, NVIDIA, Intel, that's where a lot of, how should I say, public traders seem to get a lot of the value of this AI, maybe bubble, but explosion.
So the answer is I'm focused on DeepMind and Demis Hassabis, which is fundamentally a kind of coding AI algorithmic company. But, hardware comes into it because it's certainly the case that advances in chips explain part of the advance in AI. It was really when graphics processing units, the NVIDIA chips, the GPUs as they are called, when those began to be incorporated into AI systems around about the late 2000s, 2008, 2009, 2010, that's when these systems started to work better. And that has underpinned the progress. If you look at, image recognition starting to work, that was based on GPUs. If you look at AlphaGo, the first system to beat a human champion at playing Go, that was based on TPU chips, which are the sort of Google proprietary semiconductor technology that rivals NVIDIA's GPUs. So yes, hardware is definitely in the background of my story.
I've asked a ton of questions. Suk and Will, please jump in if you all have any questions. I have more.
Sure. So, Mr. Mallaby, on the topic of artificial intelligence, your book, The Power Law, was published in 2022, but in November 2023, Sam Altman, the high-profile CEO of OpenAI, was pushed out of his company by the board of directors. the company fell into disarray, sparked an employee revolt, elicited a public apology from one of the board members who ousted him, and then 4 days later, he was reinstated as the CEO. I'm wondering, from your perspective, what is to be learned from this bizarre sequence of events? And if you were to produce an expanded edition of the Power Law, would you dedicate a chapter to this saga?
Yeah, I might too. So the specifics of this example, in other words, OpenAI, Sam Altman, the revolt against Sam Altman, that's not really a venture capital story, because OpenAI's capital has come from Microsoft primarily, as opposed to from venture capitalists. So I think I would write, in the context of a book about venture capital, the Power Law, I would be more inclined to write about the application layer of what's going on in AI right now. Because if you go and speak to VCs, that's what they are really focused on. They're focused on building a company that, let's say, serves the legal industry or some other specific industry, and makes an application from the powerful large language models that will be a useful product for a particular group of specialists in one industry. So I probably would write about that. I do think it's getting a bit bubbly, as with all bubbles. As George Soros used to say, the best thing to do with a bubble is to invest in them for a bit, because they tend to carry on going up for a while. So it's always difficult to judge. Are we in innings 3 to 6, or are we in 6 to 8, or might we be in the 9th, in which case you should get out. But I do think that the level of investment excitement in AI for the last couple of years has been unbelievable, and it is an A+ technology, but it may not be yet an A+ business model. And so you could see a lot of people investing to build products that are good products, but they can't make money from it because 5 other companies are building the same products, and so they're going to compete against each other, and nobody will be able to charge a premium. So we're going to see how this pans out. In the late 1990s, when the internet broadband revolution took place, the companies that built the fiber optic cable were building an A+ technology, but it was a terrible business model, and none of them made profits, and many of them went bust. So we don't know how this movie is going to play out in AI.
I find it interesting, though, what Will brought up, because Sam Altman came triumphant. He came back despite the board leaving him. And it kind of goes back to that theme of the power of the individual, the power of the founder, even overcoming getting kicked off from the board. Sukin, any questions?
Yes, thank you, Tim. Just to branch off that question for AI, given your extensive research and writing, how do you foresee the role of AI evolving the next decade, particularly shaping the global economy, and then how would AI addressing social economic inequalities? And moreover, do you foresee to write a book about the AI, how AI deals with socioeconomic inequalities?
I can talk about this stuff, and obviously I think about it like lots of people do. But my fundamental view is that it's just speculation. Everybody's speculating. And, I can tell a story that AI is going to destroy huge numbers of jobs, and we're going to have massive unemployment, and it's going to create a new kind of inequality, because essentially AI will be better at cognitive tasks than humans are, and so enormous numbers of jobs will be just wiped out. And normally with technology, when jobs get destroyed, new jobs get created. But if you have a revolution which takes place really, really fast, there may not be time for the other jobs to be created straight away. And so you could be in a situation where you need the government to step forward with universal basic income or some other insurance safety net policy that helps people out because you can't expect the economy to naturally generate more jobs. So I can tell that story. Is that how it's going to work, or will the adoption of AI actually be slower? In which case there'll be more time for new jobs to be generated. To what extent can you imagine that people will adapt and move into jobs which are kind of where humans have an advantage over machines, either because it's a kind of face-to-face, person-to-person, EQ-centric sort of work, or maybe because it's like goal setting. We don't want machines to tell us what to do. So when it comes to goal setting, like being an entrepreneur is a goal setting job, being a politician is a goal setting job, being the principal of a school is a goal setting job. There are tons of things where you're not an implementer, but you're a team leader and an agenda setter, and we're never going to give those roles to machines, it seems to me. So maybe enough people can move into the goal setting function and let the machine do the implementation. I can speculate either way about this. You can tell a story, well, it reduce inequality, right? Because what happens when you introduce AI and you tell it, for example, to help salespeople to sell something, is that the less experienced salespeople get prompts from the AI and become much better, and the upskilling of those less good salespeople is much more significant than the upskilling of a really experienced, excellent salesperson who doesn't really learn much from the AI because that salesperson is already very good. So maybe it upskills the less good people to a point where they're as good as the very good people, and that reduces inequality. So there are all these different theories about the future. I've been in these conversations now for 2 or 3 years. I've heard every side of it. And I think to say with any certainty that which version of the future is going to play out is probably to claim more than you really know.
A few parting thoughts and some rapid fire questions to end this. First is I'm really intrigued to see how AI will impact founder power in the whole individual versus institution. Kind of that's like a current recurring theme broadly. And then second is you have fans and scholars of venture capital and hedge funds. I think soon to be you'll have a group of fans and scholars around your work around AI. And now for some rapid fire questions. Favorite movies?
Favorite movie?
Or movies. It doesn't have to be one. Several.
Okay, so there's a sappy movie that my family simply loves, and my kids especially, and that is Love Actually. And so that's the first one that comes to mind.
That's a British film, from what I understand. Okay, yeah. Love Actually. I thought you were going to choose a historical film like Barry Lyndon or something.
Yeah, that would promote my career more. I agree.
So please don't hesitate to just mention any movie or book. Favorite book now? That's not yours.
A favorite book?
Or books?
Yeah. So one book well, a few books. Okay, so there's one called The Money Game, which is a very readable 1960s volume by a funny writer who adopted the pseudonym, the pen name Adam Smith. So Adam Smith's The Money Game is a hilarious depiction of a bubble in late 1960s Wall Street. Very readable, and it's sort of, you discover how much stuff sort of doesn't change in finance, that there was all that craziness, and we read about, meme stocks and, crypto bubbles and all this crazy stuff today. It was kind of true also 60 years ago, back in the 60s. So I think I recommend that. I think When Genius Failed is a great book about hedge fund trading. That's by Roger Lowenstein.
Long-term capital management.
Yeah, about long-term capital management, exactly. In the world of central banking, I enjoyed a biography of Paul Volcker, the Fed chairman, which is simply called Volcker, I think. And I'm embarrassed to say I'm blanking on the author's name, but he's a professor at, oh yes, he's called, last name is Silver. And that's a good book about a central bank leader and a kind of slice of financial history. Other good books, there's a nice biography of Warren Buffett, also by Roger Lowenstein, which is simply called Buffett. That was very good. What other classics? I'm a fan. I'm just glancing at my bookshelf. I mean, Ron Chernow's books. The famous one, of course, is Hamilton, because of the fantastic musical, and I too like that one. But I also recommend, the House of Morgan, one of his early books, on the whole story of what became J.P. Morgan and Morgan Stanley, but before that was the House of Morgan. It's a very well told financial history story. Those are some ideas.
Favorite music, meaning bands or songs?
Well, maybe I should say, the Hamilton the musical. That's truly a brilliant piece of writing as well as a brilliant piece of music and entertainment. Other stuff, wow, there's so much music I enjoy. I just celebrated my 25th wedding anniversary, and my wife and I had fun picking out a whole bunch of, danceable tunes, and they ranged from, Presley and people like that, Motown back in the 50s and 60s, to contemporary stuff, which our kids have taught us about. So it's a big range.
Last question. Favorite leaders, historical or present?
Favorite leader?
Or leaders?
Yeah. That's a great question. I'm often struck by the paucity of leadership, I'm afraid. It strikes me that people, particularly in public office, you'd thought that they want to get these jobs because they want to make a difference and they want to stick their necks out and do something, courageous, but then they get into office and they sort of have to do what the polls indicate will serve their re-election prospects and all that stuff. And I find that, depressing. Why do you bother to get elected if you're not going to take a stand? So, I think some exceptions to that, I mean, this might sound a bit weird, but, back in I think this is a lesson actually worth remembering for today, because we have a huge problem with budget deficits in the United States today. That public debt has risen to a point that is actually really quite scary, even though the US has the reserve currency, which allows it to borrow in the dollar, its own currency, and that makes it much easier to borrow a whole ton without it being dangerous. But now the US has borrowed so much, I think it is really worrying, and we are running, despite the fact that the US is not directly engaged in warfare, although it's indirectly engaged, of course, in Ukraine. We're running an insanely big budget deficit, given that we're not in a recession. So I think we should look to two episodes of leadership in 1990 and 1993, when two different presidents from two different parties, George H.W. Bush in 1990 and Bill Clinton in 1993, were willing to raise taxes and to do stuff to close the budget deficit. And in both cases, those leaders paid a price, right? George Bush lost the election in 92 because he'd raised taxes, and Clinton, for raising taxes in 93, got whacked in the midterm elections in 1994. And that's when Newt Gingrich took control of the House of Representatives for the Republicans. So there was a political price to be paid, but the consequence was that, guess what, by the late 1990s, the US government budget, the federal budget, was in surplus. It's an amazing thought, right? We haven't had a surplus, for more than a quarter of a century now. And we need to get back to that kind of leadership when it comes to economic management in America.
three parting thoughts. One is on that note. Bush one was a World War II pilot, and as many of us know, he ran his first election on "Read My Lips, No New Taxes," and then he raised the taxes, and that absolutely destroyed his reelection prospects. Number two is you talked about the money game and how what is old is new, and everyone thinks it's something's new, but it's actually happened in the past. There's this famous Andy Grove quote. He's the guy who was the Intel CEO who led it to prominence, and he said, "Every generation thinks it invented sex," and I think it's a really interesting kind of historical quote. And then the last and most important thing, Sebastian, this has been delightful. Every time we chat, every time I crack open one of your books, I'm learning something new. So thank you so very much for taking the time, and I hope you have a fantastic day.
Tim, Will, Sukin, it's been a pleasure. Thank you very much.